All right, welcome everybody. It is 11 o'clock here in central Iowa. And as I mentioned earlier, we've got a little bit of a storm blowing through. So you might hear some lightning in the background or thunder. Can't hear lightning, but you can certainly see it and you can hear the thunder. So almost like I said, somewhat indicative of the economics, markets, politics, everything that's rattling around these days. Wanted to take some time here at the beginning of the quarter and update you on things that we've seen so far this year, talk a little bit about how things have changed and what we think might be coming next. Of course, I don't do predictions, but I certainly have opinions about where things might be going from here. And so I was looking through YouTube the other day, and I thought, I wonder if I could find anything that would be, somewhat reflective of markets in general and how everything is going. And so I found a quick snippet that I wanted to share with all of you here. Here we go. A 26-point rally in the tennis match can be somewhat indicative of the back and forth that we've seen lately, from the doggone Fed, doggone inflation, all the different news points. Politics, of course, is becoming front and center as well. And so I want to take a look at, if you've met with us in the last year or so, we've talked a lot about the Magnificent Seven, the large company technology stocks that are out there. We've visited a lot about the way inflation has pervaded the economy and then begin to abate a little bit and what that means. And then, of course, last year, this certainty that people had around the fact that we were going to have a recession, which never came and still has not to date. And so I want to take a look at the landscape now as we moved into the first quarter. Things have definitely calmed down in the Magnificent Seven and some of those areas. We begin to see, like I said, inflation abate a little bit. But what does it all mean? Are we seeing anything that's going to make for significant change here in the future? So before I do that, I just wanted to throw up a quick poll. And so, do you expect the U.S. economy to go into a recession in 2024 is my question today. And so last year, as I mentioned, everybody, pundits being everybody, were very exclamatory that we're going to have a recession. I think it was north of 70% of most published economists thought that we were going to have a recession for sure. And so now as we're moving into this new year and we've seen unemployment stay low, the economy will stay pretty healthy, I'm wondering what you all think. Do you think we're going to be heading into a slowdown or a recession at any point in this calendar year? All right, getting a few answers in here. So my answers are yes, we're toast, or no, happy days are here again. Okay, I'm going to go ahead and enter now. So we had a little bit of a leaning towards happy days. 66% of you feel, yes, happy days are here again. And 33% of you think that we're toast. So the leaning, and it was definitely that way during the whole poll, was more towards happy days are here again. So that's good to hear. And hopefully we can make all of that a reality as we move through the rest of this year. Okay, Matt, why do you put all these confusing charts in front of me? Well, I do it to prove points and to make things a little bit more visual and easy to understand. But got a few things I want to go through today. And I'm going to start with the tennis match, the back and forth of inflation and the Fed and interest rates, because so much of what's happening here is driving the landscape in the stock market, in the bond market, in the real estate market, in cash. All the different areas that we tend to invest in are impacted by these things. So if you'll take a look at the chart on the left, and particularly the green bars, which are energy. So these are contributors to when you hear about inflation on the news, they're talking about consumer price index inflation, and that's what this chart represents. So if you would notice back into May of 2022, the green bars were dominant. Energy was very high. We had oil prices hiked, and we had the Ukraine-Russia excursion or skirmish kicking off, and created a lot of concern about energy, particularly in Europe, how they were going to get oil if they couldn't get it from Russia. As things moderated and began to see, then you would see that oil began, and energy in particular, began to go below the bar, and those prices began to come down. And then shelter the bottom bar, the blue one, really started to take off. And all of you can attest to this. The cost for everything, from insurance to buying goods for your house, getting things remodeled or fixed up, taxes, everything to do with shelter has gone up. Any of you that have kids that are renting, or if you're renting, rents have continued to go up and stay there. It's been a very stable area of the inflation outlook. And then if we take a look at the right side, we're beginning to see this shift a little bit to where now the biggest area of inflation is in auto insurance. And all of you, once again, can probably attest to this, as we've seen prices go up as we're getting renewals from our auto providers and our homeowner insurance providers. Those costs have continued to go up. So as I've said many times, inflation is personal. If you're impacted by having to pay a lot in car insurance, that's a big part of your budget, then inflation is still very prevalent in your life. If you're a big consumer of energy, a truck driver or someone that uses energy a lot in your business, then you've seen those prices come down. So this all tells us that inflation, while it's slowed down for sure, it has by no means gone away and doesn't look like it's going to. So the next then is the Fed and the interest rate picture. And if you look on the far right-hand side, what we're trying to track is what the market expects, which are the blue diamonds the green diamonds versus what the Fed is saying. And so as we moved into early this year, there was the expectation of 6 interest rate decreases over the year. So where the Fed has been raising rates, as you can see from this chart, very rapidly in 2021, and that created a lot of market uncertainty and angst in 2022. The expectation now is that the economy is stabilized. There hasn't been as much inflation. So the Fed should be able to let their foot off the gas a little bit. Well, what we've seen is that inflation has persisted, like I just showed on the last slide. And so they've been less able to decrease. So now we're seeing 1, maybe 2, maybe 0 decreases this year. So as that news has come out, I've seen the market take it pretty well. So I think what they're seeing is that the economy is still doing okay. We are beginning to spread out into some non-interest rate sensitive areas outside of big tech. And so with all of that as a backdrop, there isn't the big concern that we have to have these big dramatic declines. The Fed does not want to look stupid. If they lower interest rates and we have another spike in inflation, that's exactly what's going to happen. So I think they're going to be very cautious here. I don't think they see any reason to stimulate the economy because we're not in a recession. And if our poll proves true, as 66% of you think we're not going to have a recession, if that's the case, there's no reason to lower rates to stimulate activity. So this will be a big bellwether in how the market behaves. This news combined with the election news throughout the rest of the year is going to drive performance, particularly in the short term. However, as we look longer term, we are seeing an economy that's pretty firm right now. All right. One of the big reasons that that's the case is that people that want a job right now can still find one. And so we've seen labor supply begin to come back up. If you look at both the left-hand side of this chart and the right-hand lower side, labor force participation continues to go up. We've seen payroll gains be pretty steady in that 250 to 275 range. And then what I found interesting was on the right-hand side of the upper corner of this, the labor force growth information. We are seeing in those blue bars a number of foreign-born folks entering the workforce. Of course, this is coming from immigration. We're not going to have a political discussion about the impact of illegal immigration, but those that are coming into work are bringing up the gap here and adding a lot to the workforce. So this will be an interesting thing to play out. And as the election pervades, this is going to be a big election issue, I suspect. But to date, they've been a contributor to the labor force growth. And so then what we've seen here is if you look at the far right-hand side, we've basically seen wage growth and unemployment come together a little bit, where wage growth for a 50-year average has been just below 4%. And right now it's right about 4%. Unemployment, same thing, also right about 4%. So historically, unemployment's usually around 6%. So we're definitely below the longer-term average. But once again, you can see it everywhere that you drive around. There's help wanted signs in lots of places, now hiring with hiring bonuses. All of that is still pervasive in this economy. So while that's the case, people think they have a job, they'll spend money. If they think if they lose their job, they can get another one, they'll also spend money. And so that spending, that consumption is what keeps things moving. So while this picture remains stable, I think you're right. I think we are going to stay out of a recession. So all of this has created the stock market, which has been very robust. While we've had some pullbacks here early in April, through the first quarter and through all of last year, we saw some nice growth. So when that happens, it comes from different areas. Does it come from earnings, or does it come from the value of those stocks getting stretched? And that's what we're beginning to see, particularly in the top parts of the market, where we're seeing the historical average of around 16 times earnings is how this is measured. Right now at 21 times earnings. I do think big tech skews this a little bit still. So I do think there are parts of the market like energy, financials, industrials, even utilities, which have gotten creamed, real estate, which has gotten creamed, are at reasonable valuations. But when you do tip into the big, heavy tech side, yeah, we're seeing some valuations that are getting a little bit stretched. And so if there is a correction, if there is a recession, you would expect that those would be the names that would be impacted first. I thought this was interesting when we look at market returns around a Fed hiking cycle. So basically, whenever the Fed has stopped hiking, in most cases, the market has gone up, both over the next few months as well as the following 10 years. And so the red bar represents where we're at right now in the current cycle. And so if the Fed is done raising rates, this would represent that bailiwick or that benchmark beginning as a new cycle. And so while I don't think we're probably ever in our lifetimes going back to zero interest rates, what we may see is that rates stabilize and or do come down to represent a slower economy, because what we're expecting for growth is around 2%. That should be fine. That should keep us moving. But if there's a hiccup along the way there, particularly in the geopolitical area, so more wars, more threats of wars, and in particular, what may happen with the oil market. I put up a chart here to show you the price of oil this year, as well as the price of gold this year. So Will and I have been looking at this a lot because we haven't seen this kind of dynamic in a long time, where we've seen these material type stocks, material type areas of the market begin to really spike. And so, like I said, it's been all big tech. So when we see oil now up 23%, we also have seen Exxon move into the Magnificent Seven, the number 4 right now. So you're seeing a change here. And I think what it's telling us is that, one, they think the economy is healthy. And two, there's a lot of concern that there could be geopolitical upset that would impact the price of oil. Gold's always going to go up when you got a lot of dollars sloshing around and you have the expectation of uncertainty. So I'm not surprised to see that. It's why I really encourage folks to own gold, because it's times like now it can prove a nice hedge. So when we saw the markets kind of retreat here the first part of March, we saw gold and oil hold up nicely. And so I think this is an interesting dynamic. I think this could be the thing that if we do have problems, it would be a big spike in oil. Marianne Bartels on my Sanctuary team agrees with me that a big move in oil, where that was to go above $100 a barrel, could cause a recession, could cause a lot of concern, because that's so essential to the growth of so many companies and so many households if the prices of our energy goes up. So think of it in terms of gas prices. When people drive by, if they see $5 a gallon, that will impact their behavior. It's very much in their face. It's also shown up then in how our sector returns have been year to date. So it was all communication sectors and inflation. We're seeing energy, financials, industrials year to date begin to reemerge. And so communication services, all that, still a top area, still an area that we want to stay invested in. But this is the reason we don't want to overweight, because you can see other areas starting to break out now, which only makes sense. There's lots of areas of the economy that can benefit from a time like now. All right. This chart I found from Bruce Melman in a subscription that I get, and I thought it was pretty interesting because it kind of shows the first 42 presidents took on 30% of our debt. The last 4, these Hanyackers, have taken on 70%. And so why do I bring this up? And as you can see, this is politically equalized from these 4 on the left-hand side. So not getting political here, just saying a lot of debt being taken on. Now I understand there's inflation, and that's obviously a huge part of that, but we've taken on a lot of debt. Well, the reason I would say this is because if our national debt is a concern, then we should be looking at investments outside of just the United States. And so I've banged the table for years on foreign stocks, and it has not been a good asset class. The U.S. has far outperformed. A lot of that's due with our interest rate regime, just being the healthiest, nation on the block and surviving the pandemic pretty well. And so as we move forward, if we can't get our debt issues under control or spending under control, that's definitely going to show up, because now the U.S. government, and you all know this from your portfolios, we can get 5% now in U.S. Treasuries shorter term if we want to. Well, they got to pay back this $70 trillion or this $18 trillion in those 5% rates now. So those yields are impacting government payback, and that's going to affect the central budget's office outlook, all of those kind of things. So you can't do this forever. And we've always wondered what the checkmate will be. I don't know what that's going to be, but there will be a reckoning with this at some point where we cannot just continue to pile on debt and print dollars and not have an impact to our economy, to our longer term growth. So a story that we'll have to watch out for, and an area that we want to keep in mind as we're building our portfolios. All right. So this quilt chart just shows if you asset allocate over time, your return is steadier. It's represented by the white boxes. And then it shows each calendar year how each different asset class is done. So we call it a quilt chart. It moves around like a quilt. The other thing I wanted to point out to you is not just the white boxes on this chart, but the green, which are large company stocks. And you can see for the number, this last period of years back to 2009 has very, very much favored large company stocks. And I think that's a lot to do with because we've had rates begin to just go like this. And so while we've reemerged, they've continued to do well. But if rates don't behave, if we do have higher interest rates for longer, inflation for longer, small companies, some of these others could really begin to do well. So we haven't allocated to mid, small companies outside developed markets, those things in a long time. This could be the bellwether or the time that says maybe this tide is shifting a little bit. So while we'll always allocate into all asset classes, we're also always looking for opportunities. Where can we take advantage of what's going on in the markets? And I think this story is one that will be very interesting as we move forward. Can't get through a second quarter webinar of anything in 2024 without discussing politics and the election that's coming up. So the noise has already begun. It's only going to get louder. It will also create volatility in the market. Now, when I say that, it doesn't mean that we need to make big changes as a result, because the changes that happen as a result of politics are usually shorter term. And so we don't want to make big reactionary changes as a result. This chart is basically saying when your guy is in charge, you have higher consumer confidence. So whoever's political party is in the White House, that political party tends to spend more and believe that the economy is on the right track. The opposite then is always true as well. And you can see from Obama to Trump to Biden, the S&P returns 16, 16, and 12. So they don't make a big change. Bush at the end of his term, as you know, had the 08 thing. So their GDP growth, though, almost identical from 1.9 to 2.2 to 1.8 to 3. So my point being, whoever gets into office, however this thing shakes out and splits, over time, it's going to settle down and it's going to create both opportunity and just some short-term challenges. So don't panic. Don't make big changes as a result of the election, because as you can see over time, it tends to normalize itself. And so we'll be talking a lot about this as we move through Q3 and Q4. But just to wrap things up, and like you, relatively positive on the economy. I think the calls for recession were way overbaked last year and based on data that wasn't accurate. A lot of belief that, and then when that happens, it creates a very unwanted bull market or up market because people are proven wrong. And so a lot of folks that I trust and read and study still say there's plenty of risks out there. There always are. There's always things that we don't know and can't see. That's why we allocate. That's why we diversify. So I think dividend paying stocks, I think having some allocation outside of just traditional stocks and bonds, and being very, very prudent in how we invest in bonds at this stage of the game will be incredibly important as we move forward here. I think we are in good shape. I like where things are sitting right now. And again, we just want to be prudent. We want to be ready for a range of outcomes. And if you're part of the PrairieFire family, that's exactly what's going on. So there is a Q&A button here. And so if you see that on your screen and you have any questions, please send them. Thank you for letting me know I was on mute. I muted it during the tennis match and I forgot to turn it back on. So I caught right back up. And when we do the replay, I'll edit that out. So thank you for that. But I'm both in the chat and the Q&A. So if you have any questions, let's give it a minute here and see, because there is a lot going on out there. There's a lot of dissenting voices that both agree and disagree with me. While we're waiting here, I'll give you just a second. The other thing that I've had Will looking into is crypto, and we've seen Bitcoin go back up into the 60,000 and above. I wish I could give you good advice on this or say this is what I think is going to happen, but it's a wild west, man. Is the only way I can really describe it. I don't see any rhyme or reason to where it goes. It behaves much more like a gold, like an asset class or a store of value, but I don't know where the value comes from. And I don't know that that's been defined yet. So I'll definitely pay attention to it. I don't want to ignore it as a trend, just like I don't want to ignore artificial intelligence as a trend. When these things come along, we can't just stick our head in the sand and say, wow, this is going to have no impact on us. Clearly it is. Clearly it is going to drive new opportunities. It's going to change the way employment works, all of those things. How crypto is going to work in the currency markets is still very unclear. The regulators still don't have a good beat on it. They are putting together investments that you can buy now that represent those. And I always tell folks that are interested in that, if you have money that you're not concerned about, that you want to set aside to see how it goes, that's where I think crypto would fit into a portfolio. But as a store of a pure asset class, I don't think it's there yet. It's definitely not something I'm going to recommend. So just a few comments there. Okay, you mentioned investing in gold. How does one do that? There's a number of ways. One of the easiest ways now is that through what we call exchange traded funds, which are positions that we can own in our Schwab accounts, and we can buy on through the stock market. That will then reflect the price of gold. So if gold goes up on a given day, this exchange traded fund would reflect that. So some of the ticker symbols are GLD or IAU that we use frequently. And what they'll do is when you see gold go up like it has 12% this year, you would see that reflected in the price of that. It won't be dollar for dollar or percent per percent, but close to it. There are expenses, but there's actual bullion backing that position up. So you have the chance to not actually have to hold the physical gold, but you can have it reflected in your portfolio's performance. And so those are the most efficient way that I found. They're also tax efficient, that you can control your capital gains when you buy and sell those, and they have daily liquidity. So they are a nice way to access the gold market, in my opinion. You are still able to go to your local guy and buy gold. You can buy Krugerrand. You can buy physical gold at gold shops. All right. Got to notice that we're soggy in Beaverdale. I'm not surprised. We're soggy in South Des Moines too. We have a good storm blowing through. So hopefully that's not a precursor to what's to come in the markets. We're going to hope for better things than that. So appreciate you all being here today. Always open for questions, any follow-ups, those kind of things. I will be saving this and replaying it and posting it on our YouTube channel. So thanks again for joining us today, and we'll talk to everybody real soon. Thanks.